You may feel both scared and excited when you are buying your first home due to many important decisions you will have to make. When you are shopping for a home for the first time, it can be easily get caught up in the excitement and make mistakes that could lead to buyer's remorse. It doesn't matter if this is your first time buying a home or if it's been years since you last purchased a house. It's essential to know what question to ask and what the pitfalls are, along with knowing where to look in the process of buying a home. First-time home buyers are prone to make errors due to the numbers of steps involved. Hello guys, welcome to my channel. In today's video, we discuss as a first-time home buyer what mistakes you should be aware of. The mistakes you make during the home buying process can negatively impact an otherwise exciting time in your life. These mistakes can range from not saving enough money to not paying enough attention to credit, to simply waiting too long to make an offer. Here are a few mistakes that home buyers make and how to avoid them. 1. Prior to applying for a mortgage, look for a home. The majority of first-time buyers begin their home search before they meet with a mortgage lender. Currently, there is too little inventory of affordable homes in the market, due to far more buyers than homes available for sale. With such a competitive market, you will have a hard time getting your offer taken seriously without a mortgage pre-approval or cash in hand. A seller won't want to take a chance on someone who cannot even confirm their ability to get a mortgage, especially when several other offers are competing for their attention. It may also be a good idea to lock in your interest rate in order to be able to truly understand your budget and not worry that your mortgage rate will be higher than anticipated when you make an offer on a house. The effect on you is that if you haven't consulted a lender and a home you love hits the market, you might be behind the 8 ball. In addition, you may consider homes that are out of your price range. To avoid the pitfalls, get a fully underwritten pre-approval before falling in love with that dream house. The pre-approval process lets the seller know that you are a serious buyer with a good credit score and sufficient finances to successfully obtain a mortgage. 2. Having only one lender to talk to. A lot of first-time home buyers make the mistake of getting a mortgage from the first lender they speak to. You could be missing out on thousands of dollars if you do not compare offers. If you shop around, you'll have a better basis for comparison, so you can be sure you're getting the lowest rates. Rather than relying on one lender, shop around for mortgages with 3 or more lenders. In light of the fact that interest rates fluctuate frequently, you should get multiple quotes on the same day. It is important to compare loan rates, lender fees, and loan terms. The mortgage approval process runs smoothly when both customer service and lender responsiveness are in place. 3. Overpaying for a house. Overextending yourself is never a good idea, even if you fall in love with homes that are beyond your budget. Staying within your budget is especially important now that home prices are trending upward. In the event of tough financial times, buying a home that you cannot afford puts you at higher risk of foreclosure. There will be less room in your monthly budget for other expenses and bills. Additionally, it can prevent you from saving for a vacation, funding a retirement account, or funding a child's education fund. Consider what you can afford instead of focusing on your maximum loan amount. In addition to your other financial obligations, just because you qualify for a $300,000 loan does not mean you can afford its monthly payments. The situation of each borrower is different, so consider your whole financial profile when determining your affordability. Your lender or broker should also know the full extent of your financial situation. After all, you'll be responsible for repaying your loan, so you won't want to struggle with an unaffordable bill. 4. Prior to finalizing the sale, applying for credit. In addition to putting your credit report during pre-approval, a mortgage lender will do so shortly before closing to ensure all is well. It is important for your lender to verify that nothing has changed in your financial profile. New loans or credit cards on your credit report can jeopardize the closing and final loan approval. The lender will check your credit one last time within about a week of closing, especially for first-time buyers. The lender may change the interest rate or fees on your mortgage if your credit score has dropped or if your debt-to-income ratio has increased. Instead, you should maintain the status quo in your finances from application to closing. Prior to applying for a mortgage and until closing day, don't open new credit cards. Close existing accounts, borrow new money, or make large purchases on existing credit accounts. You should pay your bills on time and in full every month if you can, and get your balances down to less than 30% of your credit limit. 5. Buying a home with debt. A mortgage payment when you are in debt is like running a marathon with weights strapped to your ankles. You should be financially unburdened before you take on a huge mortgage. There have been times when people buy a home when they are in debt. They then had to behold something broke in the house and they cannot afford to fix it. Ultimately, it ends up being a curse rather than a blessing. What you can do to avoid making this mistake. To avoid getting into more debt, people should put a pause on purchasing a home until they have paid off all their existing debts, such as credit cards and car loans. As soon as you pay off your debt, set aside 3 to 6 months worth of expenses and then save for a down payment on a house. The most effective way to get out of debt, save up a down payment, and do it right is regardless of what the market is doing. The benefit of buying a house that way is that you can enjoy it instead of just buying it. 6. Based on the assumption that you need to put down 20%. It is a myth that you must put down 20%. A 20% down payment can help you avoid mortgage insurance, but many buyers today can't put that much money down. According to the National Association of Realtors, the median down payment for a home is 12%, and it is 6% for first-time buyers. For co-ops or condos, your real estate agent can advise you on specific community requirements. In addition to requiring years of savings, it could prevent you from accomplishing other financial goals, such as increasing your retirement savings, saving for an emergency fund, or repaying high-interest debt. Consider other mortgage options instead. If your credit score is 580 or higher, conventional mortgages with PMI require only 3% down. A mortgage without a down payment might even be possible depending on the type of loan you obtain. As a first-time home buyer, you might qualify for programs designed to assist first-time home buyers. 7. In search of the unicorn. In both nature and real estate, unicorns are mythical creatures. By trying to find the perfect home that checks all your boxes perfectly, you might miss out on good, suitable options in the hope that something better will come along. Your search can be sabotaged if you take a big picture view. If you strive for perfection, you may overpay or limit your real estate search. Keep an open mind about the market's options when it comes to rolling repairs into your mortgage. 8. Failing to consider FHA, VA, and USDA loans. With rising home prices, first-time buyers may find it hard to qualify for conventional loans if they have little saved for a down payment or if their credit isn't stellar. This might cause you to delay your home search as you assume you do not have any financing options. Instead, check out one of the 3 government-insured loan programs offered by the Federal Housing Administration, the Department of Veterans Affairs, and the United States Department of Agriculture. The following is a brief overview of each. There is a 3.5% down payment requirement with a minimum credit score of 580 for FHA loans. Borrowers without excellent credit or little savings may be able to fill the gap with FHA loans. However, these loans come with a major drawback: mandatory mortgage insurance, which must be paid annually and at closing. The VA backs VA loans for eligible active duty and veteran military service members and their spouses. A funding fee may be charged by some borrowers on these loans, but there is no down payment required. Private lenders offer VA loans, which are capped by lender fees to keep borrowing costs low. In rural areas, USDA loans help moderate to low-income borrowers buy homes. In order to qualify, you must buy a home in an USDA-eligible area. Among USDA loans, some borrowers with low incomes do not need to make a down payment. 9. There are hidden costs associated with homeownership. Homeowners will likely be shocked by the other costs associated with owning a home in addition to their new principal and interest payments. As a new homeowner, you must budget for other expenses, such as property taxes, mortgage insurance, homeowners insurance, hazard insurance, repairs, and maintenance. Homeowners pay an average of $2,000 a year in maintenance. A lack of cushion in your budget can result in you being in the red if you don't have a rainy day fund. A real estate agent or lender can help you calculate taxes, mortgage insurance, and utility bills instead. Before purchasing insurance, compare quotes. Annually, set aside 1% to 3% of the purchase price for repairs and maintenance. 10. There are no negotiations regarding homebuyer rebates. Homebuyer rebates, also known as commission rebates, are unfamiliar to most first-time buyers. In addition to the rebate, buyer's agents receive a commission of up to 1% of the sale price. Generally, home buyers can qualify for rebates, but not in all states. 10 states prohibit home buyer rebates: Alaska, Alabama, Iowa, Kansas, Louisiana, Mississippi, Missouri, Oklahoma, Oregon, and Tennessee. If you live in a state that allows home buyer rebates, you might want to ask your agent if they are willing to provide one at closing. In the case of a $300,000 home purchase, this can save you $3,000, so it's worth asking. 11. There is no consideration for moving costs and other upfront costs. After buying a house, you should have some savings left over. When it comes to renting a truck, hiring movers, buying boxes, and storing, moving can be expensive even if you do it yourself. The house may also need some repairs or changes before you move in. Your furniture and other belongings won't be affected by any painting or construction you want to do before you move. Don't forget to include these costs in your budget when buying a home. Okay guys, thanks for watching. That is all for today. If you like my video, please click on the like button. Subscribe to my channel for more financial videos, and